The basics of banking. What is a bank? Let's dive into the world of banking and understand its fundamental role in our lives. A bank is a financial institution that plays a pivotal role in the economy. It serves as a safe haven for your money and offers various financial services. Banks are very important to the economy. They act as the backbone of financial stability and growth, ensuring that money flows smoothly through the system. They provide a variety of services from basic savings accounts to complex investment opportunities. These services cater to both individuals and businesses. These services include safeguarding deposits, lending money, and facilitating financial transactions. Whether you're depositing your paycheck or taking out a loan, banks are there to assist. At their core, banks act as intermediaries. They bridge the gap between those who have surplus funds and those who need funds. They connect those who have surplus funds or savers with those who need funds or borrowers. This connection is vital for the functioning of the economy, with those who need funds or borrowers. This process is crucial for economic growth, enabling businesses to expand and individuals to achieve their financial goals. This process is crucial for economic growth. Without banks, many businesses would struggle to get off the ground, and economic development would be stunted. Imagine a world without banks. People would have to keep large sums of money at home, which would be both risky and impractical. People would have to keep large sums of money at home. This would not only be risky but also highly inconvenient, making everyday transactions cumbersome. This would be risky and inconvenient. Managing finances without the help of banks would be a daunting task for most people. Businesses would struggle to find funding for expansion. Banks solve these problems by providing the necessary capital for growth and development. They provide a safe place to store money. Beyond just storage, they offer security and peace of mind, knowing that your funds are protected. They lend money to individuals and businesses. This lending is essential for personal milestones like buying a home or for businesses looking to expand. This helps the economy grow. By supporting both personal and business financial needs, banks play a crucial role in fostering economic prosperity. A journey through time, the history of banking. The concept of banking has ancient roots. Some scholars trace it back to Mesopotamia. Clay tablets from that era suggest the existence of early forms of lending and deposit-taking. In medieval Italy, merchant banking flourished. Powerful families like the Medici established banks. These banks financed trade and commerce across Europe. The Industrial Revolution led to the rise of modern banking. The need for large-scale financing grew. Banks played a key role in funding industrial projects and infrastructure development. Today, banks continue to evolve. Technology has transformed the way we bank. Online banking, mobile payments, and digital currencies are changing the landscape of finance. Safekeeping and access. The role of deposits in banking. Deposits are the lifeblood of the banking system, providing the essential funds that banks need to operate and offer services to their customers. Without deposits, banks would not be able to function effectively. Deposits are the foundation of banking. They provide the necessary liquidity that banks require to meet the demands of their customers. When you deposit money into a bank, you are not just storing it, you are enabling the bank to use that money for various financial activities. When you deposit money into a bank account, you are essentially lending that money to the bank. This allows the bank to use your funds to make loans to other customers, invest in different financial instruments, and support the overall economy. The bank promises to keep your money safe. This is achieved through a combination of physical security measures, such as vaults and security guards, and digital security protocols to protect your account information. It also promises to allow you to withdraw your money when you need it. This accessibility is crucial for customers who rely on their deposits for daily expenses and financial planning. Banks use deposits for a variety of purposes. They are not just sitting idle. They are actively managed to generate income and support the bank's operations. They use some of the deposits to make loans. These loans can be for personal use, such as buying a home or car, or for business purposes, helping companies to grow and expand. They use the rest to cover operating expenses and to maintain reserves. These reserves are essential for ensuring that the bank can meet its obligations and provide a buffer against unexpected financial challenges. Reserves are funds that banks hold in case of unexpected withdrawals. This ensures that the bank can provide customers with their money even during times of financial stress. There are different types of deposit accounts, each with its own features and benefits. These include checking accounts, savings accounts, and certificates of deposit, each designed to meet different financial needs. Checking accounts provide easy access to funds through checks and debit cards. They are ideal for everyday transactions and managing monthly expenses. Savings accounts typically offer interest on deposits. This makes them a good option for those looking to save money over time while earning a return on their deposits. The safety of deposits is paramount. Banks implement rigorous security measures to protect your money and personal information from theft and fraud. Governments establish deposit insurance programs. These programs are designed to protect depositors by insuring their deposits up to a certain amount, providing peace of mind. These programs protect depositors from losses in case a bank fails. This ensures that even in the worst-case scenario, your money is safeguarded, maintaining trust in the banking system. The engine of growth: understanding loans and credit. Loans and credit are fundamental components of the modern financial system, driving both personal and economic development. They enable individuals to achieve their dreams and businesses to expand their operations. Loans are the lifeblood of the economy. They provide the necessary capital for various activities from buying a home to starting a new business. Without loans, many of the advancements and conveniences we enjoy today would not be possible. They provide individuals and businesses with the funds they need to invest, grow, and prosper. For individuals, loans can mean the difference between renting and owning a home, or between struggling and thriving financially. For businesses, loans can be the key to innovation and expansion. Banks play a crucial role in facilitating this process. They act as intermediaries, assessing the creditworthiness of borrowers and providing the necessary funds. This process involves a thorough evaluation of the borrower's financial history and current situation. When a bank makes a loan, it is essentially creating new money. This is because the loan amount is credited to the borrower's account, increasing the total money supply in the economy. This new money can then be used for various purposes, stimulating economic activity. This is because the loan amount is credited to the borrower's account. The borrower can then use these funds to make purchases, invest in their business, or cover other expenses. This process helps to keep the economy dynamic and growing. This increases the total amount of money in circulation. More money in circulation means more spending, which can lead to economic growth. However, it also requires careful management to avoid inflation and other economic issues. Banks charge interest on loans. This interest is the cost of borrowing money and serves as the bank's profit. The interest rate can vary based on several factors, including the type of loan and the borrower's credit history. This is how they make a profit. By charging interest, banks can cover their operating costs and generate revenue. This revenue is then used to provide more loans, pay interest on deposits, and invest in other financial products. The interest rate charged depends on various factors, including the borrower's creditworthiness and prevailing market conditions. A higher credit score usually means a lower interest rate, as the borrower is seen as less risky. Conversely, a lower credit score can result in higher interest rates. Loans come in various forms. Each type of loan is designed to meet specific needs, whether it's for buying a home, starting a business, or making a large purchase. Understanding the different types of loans can help borrowers make informed decisions. Mortgages are used to finance home purchases. They are typically long-term loans with fixed or variable interest rates. Homeownership is a significant milestone for many, and mortgages make it possible for people to buy homes without having to pay the full price up front. Business loans provide capital for startups and expansions. These loans can be used for various purposes, such as purchasing equipment, hiring staff, or expanding facilities. Access to business loans can be a critical factor in the success of a new or growing business. Consumer loans help individuals finance purchases like cars or appliances. These loans are usually shorter term and can have fixed or variable interest rates. They enable people to make significant purchases without having to save up the entire amount in advance. Section 5. The multiplier effect: how banks create money. Banks don't just lend out the money that people deposit. They can actually create new money through a process called the money multiplier effect. Here's how it works. When a bank receives a deposit, it is required to hold a fraction of that deposit as reserves. The remaining amount can be lent out. When that loan is made, the borrower typically deposits the money into another bank. That bank can then lend out a fraction of that deposit, and so on. This process repeats itself, with each loan creating new deposits and increasing the money supply. The money multiplier effect amplifies the impact of each initial deposit. Section 6. Modern banking and action examples from today's world. Modern banking encompasses a wide range of services beyond traditional deposit taking and lending. Here are some examples of how banks operate in today's world. Investment banking. Investment banks help companies raise capital by issuing stocks and bonds. They also advise on mergers and acquisitions. Asset management. Asset management firms manage investments on behalf of individuals and institutions. They invest in a variety of assets, including stocks, bonds, and real estate. Payment processing. Payment processors facilitate electronic transactions, such as credit card payments and online transfers. Fintech. Financial technology companies are disrupting traditional banking with innovative products and services. Examples include mobile payment apps, peer-to-peer lending platforms, and robo-advisors. Section 7. The 2008 financial crisis, a cautionary tale. The 2008 financial crisis was a stark reminder of the importance of sound banking practices and regulation. The crisis was triggered by a combination of factors. These factors included lax lending standards, excessive risk-taking by financial institutions, and a complex web of financial instruments. When the housing bubble burst, it triggered a chain reaction. Mortgage-backed securities, which were widely held by banks and investors, plummeted in value. This led to a credit crunch and a global recession. Section 8. The importance of regulation, ensuring stability and trust. The 2008 financial crisis highlighted the crucial role of regulation in maintaining a stable and trustworthy banking system. Governments establish regulatory frameworks to oversee banks and other financial institutions. These frameworks aim to protect depositors, prevent systemic risks, and promote fair and transparent financial markets. Key aspects of banking regulation include capital requirements, which ensure that banks have enough capital to absorb losses, liquidity requirements, which ensure that banks have enough cash on hand to meet short-term obligations, and consumer protection laws, which safeguard consumers from unfair lending practices. Section 9. The future of banking innovation and challenges. The banking industry is constantly evolving. Technological advancements, changing consumer preferences, and new regulations are shaping the future of banking. One major trend is the rise of digital banking. Online and mobile banking channels are becoming increasingly popular. This is prompting traditional banks to adapt and innovate. Another trend is the emergence of fintech companies. These companies are challenging traditional banking models with innovative products and services. They are also expanding access to financial services for underserved populations. The future of banking will be shaped by how well banks can adapt to these changes while maintaining the trust and confidence of their customers.